Hello, everyone. Welcome to IUL 101 today. This is Jason Cannon with LFS. We really appreciate you taking time out of your schedule to tune into our recordings and our conference calls. It means a lot to us. This is going to be the last in our product conference calls. So we've covered term and term with living benefits. We've covered GUL and whole life. And lastly, it's IUL 101. These calls are recorded. Everybody that is registered for these calls will receive an emailed copy of it, so you can listen to this again at your leisure. And with that being said, we're going to jump right in here. IUL 101, this is a basic IUL level call, so please listen. If you have any questions, we do have a questions box where you can shoot those over to me. Ask as many as you'd like. The more, the better. We are going to keep the questions at an at a 101 level, though. So if your question is maybe a little more in-depth or a little more kind of odd, I'll acknowledge that you sent the question in, but you and I, maybe let's touch base after the call just to not get off track of the IUL schedule here. Also, you will see that we have an IUL Quick Tips handout. So for those of you that are new to this subject, I would suggest printing that out or saving a copy to your desktop. That'll answer a lot of the basic questions that your clients are going to ask you that you may not know off the top of your head. It's going to come in really handy and be quite a time saver. And lastly, please stick till the end of this call. We have two very exciting announcements to make for going forward from these calls. So we know you're going to really like the information we're going to share at the end of this call. So with that being said, let's jump in here. IUL, what is Index Universal Life, and how do we properly build a plan to meet our clients' needs? Index Universal Life insurance plans. Okay, sorry about that little glitch there. So we're going to have some important terms to know before we get started here. So in this call, you're going to hear me use the term MEC. MEC stands for Modified Endowment Contract, and essentially what that means is there's a limit to how much premium a client can put into a plan based off that plan's death benefit. Once they exceed that limit of premiums that they put in, the plan, if it has cash value in it, which an IUL does, that cash value becomes taxable. So we're going to get into a little bit more into what MEC is here in a little bit, but just know that when I use the term MEC, it stands for Modified Endowment Contract, and as long as we're staying within the MEC limits, that cash value building in your client's policy, when they go to access it, they can access it tax-free. Lastly, the other term to need to know here is cost basis. Really, cost basis simply means how much total premium your client has put into their plan. Those are two very important terms to know, especially when we're talking about IULs. So here's our graph that many of you are pretty familiar with by now. These are all the different plan types we've covered so far, and it kind of shows you where IUL fits in the big scheme of things here. So on the left-hand side, we've got a limited guarantee. That's referring to the death benefit. There are some guaranteed death benefit IULs out there. The majority of them are going to be a limited guarantee, meaning that they're usually scheduled to last for life expectancy, which is approximately age 85. So that, along with many things in the life insurance industry, that'll vary a little bit from carrier to carrier and plan to plan. But in general, these are designed to last for average life expectancy. They are very, very strong cash value building plans. That's the main goal of an IUL, is building cash value. They have flexible premiums where your client can really kind of customize how they want their premium structure to be. And most of the time, even though they are flexible premium, we're usually going to schedule these or illustrate these on a level premium basis. So what can IUL do for your client? Obviously, this is a life insurance plan, so first and foremost, always keep in mind that there is a tax-free death benefit associated when the insured passes away. But like I mentioned a moment ago, the main goal, the main objective with IUL is cash value accumulation. That's what these plans are designed to do. And as long as we grow that cash value within those MEC guidelines, those withdrawals that your client takes out, whether they're one or two here and there, or if it's set up as an income stream, like say in retirement years, those withdrawals are going to be tax-free. So who is an IUL candidate? When you're talking to your clients, how do you know if they are or are not an ideal candidate? We're going to go through some structure here to help you determine if a client is a good or not a good IUL candidate. Keep in mind, they don't have to meet each and every one of these criteria, but the more they meet, the better. Because when it's all said and done, an IUL really has two things that you really need to focus on to make it work as ideally as possible. and that is keeping the internal cost of insurance as low as possible and allowing that cash value in the plan to grow. So it needs low internal costs and it needs some time to build it as strongly as possible. So people in their mid-20s to mid-50s as far as age range, that's a good place to start because, again, the younger a person is, the lower their cost of insurance and the more time they have to let that cash value grow. The better their health class, the lower their internal costs are going to be. So standard health class or better is usually a good target there. Obviously, non-tobacco users have much lower cost of insurance than tobacco users, and children are excellent candidates for IUL because they are going to have the absolute lowest internal costs, and they have the most time to let that cash value grow. So again, your client doesn't have to meet each and every one of these pieces of criteria, but the more they can meet, the better. So some of the main uses are college tuition assistance. If you put this plan, whether it's on an adult or on a child, and it grows cash value, and that adult has a child that is now in their college age, they can use that cash value in there to help pay for college tuition or just the normal expenses that come up during their college years. Life events are another thing that people could tap into their IUL for. By life events, we mean things like, say the client has a major medical bill come up, or maybe they have a large repair on their home or on their car. In the day and age we live in, not a lot of people have a lot of money in their savings. And so say they do have a major expense that comes up on the house. Well, if they don't have a lot in savings, but they have to fix what's wrong with the house, they have to figure out a way to pay for this. And so unfortunately, a lot of people, they have to either put this on a credit card or refinance their house or use some sort of plan basically that has interest that they're going to have to pay back. Not only do they borrow that money, but they have to borrow it with money and they're required to pay it back. Whereas if they have an IUL and it has cash value in it, and if it has enough to pay for all or at least, maybe a large majority of that bill, they can take that cash value out, help pay off or at least pay down that major repair on their house in our instance here, and they don't have to pay that money back to themselves if they don't want to. The cash value in their plan is theirs and they can use it for whatever they like. And also tax-free income. A lot of people that take out IUL, they're taking out a plan like this to set up a tax-free retirement income stream. So they put this premium dollar into their plan as they're working, and once they hit their retirement years, they can turn on that income stream and not only have money to live off of, but live off in a tax-free situation. So how do we structure an IUL? IUL quoting, IUL structuring is pretty different than traditional, like say a term plan, right? So on a term plan, you put in the client's data, so their age and their gender and their health class and the state that they live in, and then you're usually going to put in a face amount or a death benefit amount. And what we're going to ask the system for is how much premium is this going to cost my client? Well, IUL is a little bit different. We kind of go a little bit backwards at one point. We still have to put in that client's personal data. So we still have to put in their full date of birth, not just their age, but we want a full date of birth. We would like their full name, their gender, their health class, their tobacco status, and the state that they live in. But then instead of a death benefit, we're going to put in how much premium they have available. Let's say they want to pay monthly, and you have a client that wants to pay about $200 a month. That's fine. We can put that in, and what we're going to solve for is what's called minimum death benefit, maximum cash value. The system will find the smallest death benefit possible to allow all of that client's premium to go into that plan and keep building cash value, and also residually the death benefit will keep growing to stay within those MEC guidelines so that they don't have a taxable event happen when they go to take their money out. We also need to know how long they want to pay for. Let's say, for instance, you have a 30-year-old client and they plan on retiring when they're 65. So you let us know not only their personal data and how much premium they want to pay every month, but when do they want to stop paying? How long do they want to pay for? In that situation, they'd want to pay for 35 years. Then they're going to turn off their premium and they're going to turn on the income. So we need to know all of that data. Now, if you're a little worried about trying to keep all that straight, don't worry. On the LFS website, we actually have an IUL quote request portal set up for you. It's electronic, so there's nothing that you have to print out, fill out, scan back in, and email. You simply go to the LFS website, and then under the heading of quotes and sales support, you'll get your drop down, and you can click inside there. You're going to have a blue button that says IUL quote request. You click on that, It's going to bring up a new screen for you, and everything I'm talking about here will be brought up right in front of you. You type it all in. It's going to literally walk you through everything that you need to enter into the system to build a proper quote request. That'll come to us electronically and automatically and instantly. We'll receive it, we'll work up the quote and email it right back to you to be able to share with your client. And once we get that, then you'll be ready to go out, meet with your client, show them the illustration, and go from there. So let's talk a little bit more about our solve and about MEC. So like I said, we solve for minimum death benefit, maximum cash value to stay within those MEC guidelines. And I like to use the water balloon theory for those of you that maybe have a hard time grasping what I'm talking about. Think about it this way. You've got a water balloon, like when you're a little kid and you're going to go get in a water balloon fight with your friends, right? So you're going to hook up that water balloon to a faucet and you're going to turn on the faucet. You're going to get as much water into that balloon as you possibly can so that you can take the balloon off the faucet and tie a knot and still hold it without having that balloon burst in your hand. Well, now let's compare that to how it would be with an IUL. So instead of a balloon, the policy, the IUL policy is actually the balloon, and the premium dollars represent the water coming from the faucet. So we're going to put as many of those premium dollars into that plan as possible to fill it up as much as we can without exceeding those MEC guidelines. Because as we all know, when a balloon pops, you can't unpop a balloon, right? Once you pop it, it bursts and it's over. There's no undoing that. It's the same thing with a MEC. Once a life insurance policy becomes a MEC, you can't undo that. You can't take money out to get under those MEC guidelines. Once it's a MEC, it's always going to be a MEC. So that's why we solve the way we do, to stay within those guidelines so your client can retain that tax-free income advantage. So here's a quick graph to show you how these plans work. What we've got here are three versions of essentially the same female. And so let's start on the right-hand column. So we've got a 45-year-old female who's going to put $400 a month into her plan to age 64, and then she's going to stop paying and she's going to have retirement income. So as you'll see, the top line, she's got her $400 a month premium. In year one, her death benefit is just over $205,000. Her cash value by the age of 65 is $144,734. And if she were to turn on her tax-free income stream every year, she would receive $13,320 in income, tax-free income. And in this scenario, she would have paid a total of $96,000 into this plan. So what happens if she would have started 20 years earlier? So let's look at the middle column. She's 25 at this point. She's putting in $200 a month. And what you can see is in day one, her death benefit is almost $150,000 more than if she waited 20 years. She's got a $351,000 death benefit. By the time she's 65, her cash value is almost $314,000. And now one of the bigger numbers that's really going to catch your eye is her income from age 65 to 100. Now her income is just under $30,000 a year tax-free. So more than twice as much tax-free income as if she would have waited till she was 45. And as you can see on the bottom line, she would have, in this scenario, put in the exact same amount of money. She just would have started earlier, which means she would have had lower cost of insurance and she would have had more time to let that premium grow. So that's a pretty big difference to help you understand how these things work as far as time frame goes. But here's the real cool column, in my opinion. Let's look at the first one. As a one-year-old female, if her parents would have taken out a plan on her, and they would have set it up to pay only $50 a month until their daughter, their one-year-old daughter, turns 65, her death benefit starts out fairly low, $66,746. But this is a child, so that's fine. That's going to grow over time. By the time she hits age 65, you'll see her cash value is $437,000. And here's the best part. Her income from 65 to 100, tax-free annual income, $91,632. That's a pretty good income for somebody to live off of, especially considering it's tax-free. And the beauty of this, because they started early and because the child had such low cost of insurance, they only had to put $50 a month premium in. So they only put in a total of $38,400. In the first year of retirement, this child would have taken over twice that amount out just the first time for income. So as you can see, talking to parents about putting IUL on their child, It's a pretty robust plan that can really go a long way for not a whole lot of money. Some of the basic questions you're going to run into here, since these are flexible premium plans, your clients may say, well, this is great. I've got maybe $100,000 or $200,000. I just want to dump it into the single premium. Can I do that? Generally speaking, no, because on top of just the premium going in, it's the amount of time that it takes the premium to go in that can affect MEC status. So a single premium plan is going to be a MEC, but there are ways around that. So if you have a client that really loves the idea of an IUL and they've got this large single premium, by all means, that's not a deal breaker. Still fill out the illustration request and shoot that over to us. Let us know that that's how much money they have in a single premium, and we can show you how they can spread that out over a short amount of time to avoid MEC. But if they don't want to do single premium, let your clients know, in general, usually between 5 and 7 years is about the shortest amount of time that a client can pay into this plan and stay within those MEC guidelines. These are flexible premium plans. So technically, yes, a client could potentially pay more or potentially pay a little bit less into their plan. But here's what you need to understand, and here's what you really need to make sure your client understands. If they pay more into this plan, we're at tax time right now. So say your client has an IUL. Maybe they've had it for a couple of years and it's performing great and they love it, and they just got a really healthy tax return. They think, hey, I want to do something that I feel is responsible. I'm going to take my return, I'm going to dump it into my IUL and just help grow that cash value more. Well, what they're going to run into in that situation is the potential of causing this plan to MEC, because they're going to be putting in more and possibly even substantially more than they had the plan illustrated and issued. And so they could potentially run the risk of MECing their policy and losing that tax-free withdrawal advantage. On the other end, if they don't pay as much as has been scheduled, they can run the risk of lapsing their policy. Maybe it's around Christmas time. They run a little bit low on money and need to get a few more presents for the kids, and they think, oh, hey, maybe I'll skip my insurance premium this month or something. Well, probably skipping 1 month between you and I probably won't totally crash the policy. But what you can run into here is they may develop a bad habit of doing it more than once, possibly even many times, and lapsing their policy. So although these are technically flexible premium plans, I would encourage you to talk to your client and approach the premium from a standpoint of they would just like a term plan, meaning that whatever we illustrate, they pay that exact same premium every month or every quarter or how often they're paying for the same time that we've structured it for. If they're going to pay $300 a month for 35 years, I would stick right to that as much as possible. When they can access their values, again, is going to vary a little bit from carrier to carrier, but I would usually encourage my clients to wait about 15 years. The reason is kind of twofold here. First of all, IULs are going to have surrender charge periods built into them, and those the length of those periods can vary from maybe, say, 10 to 12 years. So if your client waits at least 15 years before they access their cash value, chances are, for pretty much most every policy out there, they're going to be outside of the surrender period. So that's the number one advantage of waiting for 15 years. The other advantage is really just letting this thing get growing from a strong foundation early on. If you put the money in and immediately start taking the money out, the plan really doesn't have a chance to grow very well. So a little bit of patience there up front is really going to pay off huge in the long run for the client. These are traditional life insurance policies, meaning they're not variable plans. So your regular life insurance license is all you need to sell an IUL. The other question you'll get asked a lot, and I didn't address this earlier, and I want to make sure I do without forgetting, is how much premium does a client need to pay into this plan to make it work, to make it look good? There's really no set answer for that, but what I would suggest to you to keep in mind is whatever decade of age your client is in, I would encourage them to pay about that many $100 per month. What I mean by that, if they're in their 20s, I would start off by suggesting around $200 a month. If they're in their 30s, $300, 40s, $400, and so on. Now, if they don't have that, again, that's not a total deal breaker. But if you've got someone in their mid-40s and they love the idea of an IUL and they may be in great health and non-tobacco and all that stuff, but they only have like $75 or $100 a month to put into it, this might not be the right plan for them. So they don't have to have that exact amount that I'm suggesting to you, but try to make sure that they're fairly close to it to make sure that this plan actually works and looks good for them. Because if they don't have enough premium to put into it, we might need to talk about a different plan for them. So, as I said at the first of this call, two really exciting announcements here going forward. The first one is that we now, on the LFS website, under our Education tab, we have 5-minute versions of our original 3 webinars posted for you to use at any point in time. Like I said, they're about 5 minutes, some a little bit more, some a little bit less, but there are 3 videos. One video on term, we've got the other video on permanent, which is GUL and whole life, and then lastly, we have our IUL video. It's the exact same content you have here on these calls, but just in a really shortened, more condensed format. Those are for you to use at any point in time. We have also made them, they're carrier agnostic. They don't have full illustrations in them, so you can share them with your clients. If you're a little bit nervous about talking, like say on IULs, for instance, if you don't feel totally comfortable describing IUL to your client, you can share that video with your client while you're sitting with them in your office or at their kitchen table. They're going to be short videos. You're not asking a lot of their time, and they're packed with all of this information just in a shorter format. The second announcement is 2 weeks from today, we're kicking off our next round of 101 courses where we're going to be focusing on underwriting, field underwriting, and the new business process. So we can't wait to kick that off. 2 weeks from today is going to be our field underwriting 101. So for those of you that are new to the business in general, or maybe just need a few quick tips and to brush up on your underwriting skills while you're out there in the field, we'd encourage you to tune into that call as well. Thank you all so much for your time today. We hope this gives you a better understanding of IUL, how the plan works, and where it really kind of fits into your book of business, as well as how it fits particular clients of yours. If you're new to LFS and you haven't had your one-on-one training call, please reach out to us. Let us know that you'd like your walkthrough, and we will compare our calendar to yours and make sure that we get you on the phone. We'll walk through our website. We'll show you where things are located so you can pull applications and run term quotes or whatever it is you want to do and need to do. And also just answer questions on how you do business with us in general. If you have had your one-on-one call and maybe you've forgotten a little bit or you want a refresher, that's no problem as well. Please, again, reach out to us. Let us know you'd like a walkthrough, and we'll be happy to accommodate you. With that being said, we haven't had any questions come through, so I'll give it another second or two here. But just thank you so much for your time. And again, 2 weeks from today at the same time, we're going to be kicking off the underwriting series. It's going to be Field Underwriting 101. We think you're going to find some very valuable content there and have a lot of good positive takeaways from that. With that being said, thank you so much for tuning in. Have a great day, and we will talk to you in 2 weeks.